All right. Hello, everybody. I can see people rolling in now. Christian, Sarv, how are we doing today?
Fantastic.
Great to have you, Christian, once again. Sarv, how are we doing?
All good, Kirk. Excited.
Good. Well, thank you both for joining. Today, obviously, we are talking about a very big topic. Specifically, we will be talking about the world of SaaS forecasting. This is a big world to talk about, as you can probably imagine. The global landscape has been changing the last couple of years. On average, SaaS has a CAGR of around 12% every single year. 80% in the recent studies, 80% of businesses use a SaaS product. And IT departments could have up to 25% of their spend on SaaS products. So now more than ever, it's an important time to be able to forecast your SaaS. It's a growing business. And so we're really excited to have Christian and Sarv today, lead industry experts on this topic. In fact, this would be a good time for you guys to introduce yourself. I'll start with me. Who am I? I'm Kirk. I'm the Director of Strategic Finance here at Drivetrain. My past has been modeling specifically for IPOs. Now, obviously, with Drivetrain, moved from Excel to a system world. The formulaic expressions we use for forecasting remain the same, and that's what we'll be chatting about today. Christian, I'd love to hear a little bit about your background. What brought you here today and made you the FP&A expert?
Sure. I don't know if I'm the FP&A expert, but so my background, I started my career in FP&A at Procter & Gamble. I spent 4 years there, then 7 years at Unilever. And after my MBA, I transitioned into tech, and I had a chance to lead an FP&A team at Squarespace. It's a website builder company when we took the company public. And it was a fantastic time because, we learned how to get the CFO ready to stand in front of analysts and tell the financial story of the business. And we looked at the business and the forecasting from all angles. And then I also worked at a smaller Series B B2B SaaS company in the FP&A tool space. And when I transitioned from consumer goods to SaaS, I realized that a lot of the challenges that FP&A people face are actually very similar and independent from industry and company size. Things like, how do I improve my forecast accuracy and at the same time make the forecast more useful for decision making? Or how do I build a financial model that's optimized for fast iteration? Or how do I manage a collaborative planning process? And when I realized that, I also thought, okay, I really enjoy teaching because, what I enjoyed about being a leader is really helping my direct reports develop their skills, advance in their careers. And so I thought, maybe there's a way for me to teach FP&A. And, a few short years later, now I'm the director of the Wharton FP&A certificate, and I'm a corporate trainer, and I teach FP&A full-time.
Wow. Well, Christian, we are looking forward to learning from you today and taking that breadth of industry experience to figure out how we can best forecast the SaaS world. We also have Sarv here. Sarv's a fellow Drive trainer. He's the head of product and RevOps. Sarv, I'd love if you could give an overview of what brought you here and what made you a RevOps expert.
Yeah, hi folks. I'm Saurav. I lead product and RevOps at Drivetrain. Used to be a venture capitalist looking at SaaS companies in an earlier life. Yeah, but now I've been doing this for the last couple of years. Have worked with a lot of our customers in the SaaS space across the spectrum on the RevOps topic. So I have a fair bit of understanding of how this is done and have seen customers use these methods up close in live. So yeah, excited to be a part of this discussion today.
Well, thank you both for being here. We're really looking forward to learning from you. Let's talk a little bit about what we'll be talking about today. We've been through our introductions. After this, we're going to talk about the types of SaaS sales forecasting. There's obviously not a one-size-fits-all. There's various different factors we need to consider when it comes to making our forecast. What's our company size? Or what's our timeline? We'll talk a little bit about those. Triangulation is something that not a lot of people in the forecasting world have heard of. Christian will be giving us a little bit of an overview about that. And that'll help us eliminate our what we call forecast bias. And then lastly, we'll get into a little bit of a deep dive with some real world examples. So we're not just getting the theory today, we're also going to be able to practically implement what we're learning. What you can expect to walk away from in this session is, here we go. We have a poll. Feel free to answer this poll over right now or the next slide. But essentially what you're going to be seeing here is one of two things today, and then something in the future that we're going to be adding over the next couple of months. Firstly, sales forecasting and techniques. That's the theory. The second piece is that practical piece that I was talking to you about, where once we learn this theory, how do we actually create a model using those things? The last piece here is something that's actually going to be coming out over the next couple of months. We're going to be having deep dive master classes from Drivetrain on each of these forecasting techniques. So keep a keen ear to what you're hearing today. If there's something that specifically jumps out at you, we'll be happy to teach you a little bit more about that. Let's start us off really quickly here with the poll. You probably would have seen this pop up on your screen. If you're willing, feel free to answer that poll. There'll be a couple more polls coming down the line here. This is just the first one. And then once you have answered, feel free to tune back in right here. Let's start with this, the sales forecasting overview. Here are some factors that we should consider, right? There's two high-level ones. The first is the go-to-market sales motion, right? And the second is the forecast period or horizon. You can see a couple of items listed here. Sales-led growth, bifurcated by both the SMB, mid-market, and enterprise levels of customers, is one thing that very much has to be considered. You can bifurcate that type of forecasting across each of these forecast period / horizons on the right. It might look a little bit different when you're doing sales-led forecasting in the current or next quarter versus when you're doing it 12 months from now. We're going to talk a little bit about that. Product-led growth, prosumer, right? A mix between your producers and your consumers. That might look a little bit differently than how you would do your sales-led growth. And then, of course, there's always going to be a hybrid / multiple growth engines, all feeding these various different forecasting methodologies. So I'll pause right here really quickly. Christian, any comments on what you've seen here? Are there other factors that you've seen in all of your industry experience that might be an addendum to each of these two factors?
Yeah, so the factors you have here are definitely absolutely key, but there are others. So for example, how volatile your business environment is can also influence the choice of your forecast technique. So for example, let me share an example of my time at Squarespace. For those of you who don't know, Squarespace is a website builder company that sells software and services to both consumers and businesses. I led the FP&A team that was responsible for marketing and growth. And during the pandemic, we saw an uptake in subscriptions, as many other companies saw as well. And we, the FP&A team, had to figure out how much of that was a one-off and how much of that would be sustainable throughout the years, after the pandemic. And that was no easy task because basically all of our forecasting methods that we used completely fell apart because the business environment just changed so drastically with people being home. And so what we ended up doing because of that is the company actually hired data scientists who then developed a machine learning based model. And after a lot of trial and error, we realized that if we feed the machine learning model, not just with our data, but also with geographical unemployment and even mortality rates, the forecast accuracy was back to almost how it was before. So that was just another example of how important it is to think about these factors when it comes to deciding your forecast technique.
How interesting. Saurav, anything to add to that? Any practical examples, or are these factors pretty comprehensive, mixed in with what Christian just mentioned?
Yeah, I feel like these are the major ones. Obviously, I think Christian had a great point around the volatility of the market. And I completely echo that. One of our customers in the enterprise SaaS space, when they're forecasting for the current quarter, follows like a very bottom-up model where they get inputs from reps, and then that's the way that they forecast because that's more reliable and that works for them. And this is very different from another one of our customers, which is a more product-led growth company where they've got like the concept of trials, etc., where they follow a very demand gen or a top of the funnel approach to forecasting. So like in both these cases, right, very different businesses, and hence the approach that they follow are very different. And I think that's the key factor that one needs to consider. Yeah,
definitely. Many factors to put into motion here. Let's take a look at some of these items that we can actually look through and consider. We're going to give an overview of these approaches. I'll start by giving just what these mean. And then actually, I'm going to ask Christian, you to comment on the first two. Saurav, you to comment on the second two after this. What you're seeing here are four main methods that we have typically seen in Drivetrain. Our customers that use Drivetrain, how they forecast, right? Judgment-based could be something based on the sales rep level. Perhaps the sales rep, so this would be a bottoms-up approach, would look at their pipeline, make an estimate on how much they can close, every single month, every single quarter, perhaps every single year, bifurcated across a given monthly time frame. And then we would build up our sales from there. Probability weighted would be, of course, we all have our pipeline. Depending on where a deal is in that pipeline, it could be weighted more heavily or less heavily as revenue. For example, a lead that we generated yesterday where they're pseudo-interested might be weighted a lot less probabilistically than a deal that might close tomorrow, right? Driver base would be your typical P times Q, right? Your price times your quantity, maybe your number of users times your ACV, something to that effect. And then there's always statistical analyses too. This would be further down the line where maybe we're less certain and we don't have a judgment-based probability weighted or driver-based methodology that we can implement. And a statistical approach can be implemented where essentially we might be looking at something like linear regression to give us that trending line going forward. But Christian, that's a high level. I'd love your detailed overview of at least those first two there and any other comments you might have on the other two.
Sure. So it's extremely important to understand the advantages and disadvantages of each of these methods because you want to know which one to choose for your particular situation, and you only know that if you understand the pros and cons. So the first one, judgment-based, you can also call it expert-led forecasting. It's where you ask the experts, the sales reps, to give you their point of view on the likelihood of closing the deal. The advantages here are that the sales rep consider context, nuances, intricacies, and also qualitative factors that other methods don't capture. So other methods that are more looking at historical data and other metrics, there's no way that you can know how an experienced sales rep can understand based on how the demo conversation went, for example, if this is an urgent issue for them, which makes it more likely that they will actually convert, for example. So you get those nuances. You also, it's also a technique that's very quick and nimble to adapt, because if the sales rep on the second meeting realizes that, oh, actually they may be eager, but they don't have the budget for our solution, then he can immediately, drop the probability and the model gets updated. So those are the advantages. The disadvantage is that because it's expert-led, there are going to be also biases and influences by emotions, external pressures, etc. And actually, we'll talk about the biases later in the session, so I'll go more deeper into that. There can also be inconsistencies because you may have sales reps that have different levels of seniority, they have different amounts of trainings, and so that can influence your forecasting. There can be groupthink, just because everyone thinks that once they hit a certain stage, they are more likely to close, doesn't necessarily have to be true for every individual opportunity. And then the last disadvantage is that also it's typically more time consuming because often the finance team actually wants to talk to the sales reps to, ask some questions, to test the accuracy and ask some challenging questions to improve forecast accuracy. That's helpful, but it takes time.
Definitely. Super interesting evaluation there. Saurav, anything you would add to that one on judgment base? I know I said I'd reserve 3 and 4 for you, but I know at the manager and the rep level, you kind of had a lot of experience in those teams as well.
Yeah, I think this works great for companies that are that have high ticket size products, have lesser number of opportunities, right? I think Christian made a great point where he said that employees and sales reps and managers have the most context and hence are more equipped than, let's say, your other mathematical or statistical methods in forecasting here. I think one of the good part about this approach also sometimes becomes the bad part, which is that then you're reliant on the judgment of the reps, right? And the inherent biases in terms of over or underestimation that come in with their knowledge of a deal might affect your forecast and cause you to either over forecast or under forecast. So I've seen this being used as a very common technique, but yeah, I think those are some of the points about that.
I like what you said there, that sometimes the biggest advantage of a forecast methodology can also be the biggest disadvantage. Definitely it can be the truth there. Christian, back to you.
Yeah, so probability weighted, that's where you have a more database approach. You look at your historical conversion rate at each of the stages in the funnel, so at the beginning of the funnel, when it's sales qualified, when they join a demo, etc. And then you from the top down say, okay, whenever a lead reaches that point, that's that probability, that standardized probability rate that I apply to all of the opportunities there equally. Now, the advantage there are almost a little bit inverse from the judgmental method. So you avoid human biases because it's database, it's top down in terms of assigning the rates. It's quick to update because you don't need to have those one-to-one conversations with the sales reps, and you can, if you realize that something is changing, you can change those rates. But you completely ignore all the information that the sales manager may have, that could actually help improve your forecast accuracy. And that's something that's often a bit underappreciated. If you're changing something in your sales process, or maybe even you're just hiring more experienced sales managers, you have to make sure to also review those probabilities again. And sometimes companies are a bit slow with reviewing the probabilities, and then your accuracy either over forecasting or under forecasting because you didn't dynamically reflect the changes you made to your salespeople and to the sales process. And that issue can't happen with the expert-led process, because there everything is from the bottom up.
100% agree. In my time, I've learned that there's a very thin line between making your forecast more accurate and spending too much time, and not making it accurate enough and not spending enough time. So
Exactly.
Thanks so much for that, Christian. I would love, Saurav, if you're on the driver-based one, do you have any detail behind how you would typically go about driver-based? Is there some nuance to this that people might not be aware of?
Yeah, I think one of the most interesting nuances is, like, technically there can be any driver that you can choose to forecast, right? Like, how do you figure out what drivers to use and the way that'll represent the forecast that you're looking at? So interestingly, Christian and we were speaking the other day, and he showed us a great model, which was a very holistic model forecasting the annual numbers, and that had drivers which were initiatives that the company was going to take to move their subscriptions a certain way. So that was one approach. And the other approaches are like a sales or quota capacity forecast, right? Which is effectively where the driver could be the number of deals that you expect your reps to close, the ECV, and the percentage attainment of their quota. So I think it's very interesting to say, what driver do you want to put in a way that captures the forecast that you are trying to attain? And I think that's a very interesting part about this method.
Very interesting. Christian, anything you'd add to that one on the driver-based methodology?
Yeah, exactly. Because I'm a big fan of driver-based forecasting because it forces you to look more closely at your business and to really understand your business. Because you can't have 50 drivers in your model. You have to select 5 to maybe 12 highest value drivers. And that means you really need to look everywhere in your business, need to understand the relationship between those drivers and your sales. And the other reason I like it is it's enables scenario planning. Because so let's say one driver is, okay, we're launching a new feature in our product, and we expect that this will have this and sales uplift. Then you can have a conservative, an aggressive, and a base scenario just for that driver. And then you do the same for the next driver, which is maybe, okay, we want to do more couponing, basic, conservative, aggressive scenario. And then it becomes really easy later on to say how much risk is in your forecast. Because you can say, well, for the new feature, we're very bullish. We go with the aggressive scenario. But for couponing, maybe we've done it too much in the past. Let's go with the more conservative one. And then that's a great story you can tell to your board. And it gives you a good grasp of the risk involved in your forecast.
No doubt. Yeah, one of the very interesting... Oh, sorry. Go ahead, Christian. Go ahead.
No, sorry. I was saying that's a very interesting point, Christian. Yeah.
Very much so. I was going to say that one of my favorite things with driver-based forecasting has been learning how to do sensitivity analysis, which would essentially mean of your 3 drivers, let's say, you flex each of them up 10%, each of them down 10%, and you see each of their incremental impacts on revenue. Which one, when raised 10%, has the biggest impact on revenue or net income or cash flow, whatever the case may be. But by isolating those factors, like you said, we can see the full downstream effect of the model just by changing one number up or down a given percentage. So super helpful.
The danger to keep in mind though with this, because also driver-based forecasting has disadvantages. One disadvantage is the risk of error stacking. So when you have multiple drivers that you add up to each other, it's not a science, right? It's definitely a mix of an art and a science. Each one will have a margin of error, and you have to be careful that by adding many drivers on top of each other, that margin of error doesn't get multiplied. So that's where building simpler models can be helpful.
Sure. More of a back of the napkin technique can sometimes get you 80% of the way there. And then all that effort that you put in to make it 1% more accurate adds more time, or in this case, makes it more inaccurate. Couldn't agree more. So, Sarv, maybe take us through the last one here. Any thoughts here? I mentioned linear regression, but I know there's a million out there. What are your thoughts on this methodology?
Yeah, this is a very interesting one, predominantly because I think a lot of people who come from deeper forecasting minds who prefer these methods because they feel there is a sense of accuracy. I think there are two challenges with this method, which makes it a little bit difficult sometimes for implementation. I think the first is the availability of data, which in a lot of cases, particularly for companies that have maybe slower sales cycles or in general less data, makes it a little bit difficult to execute some of these. I'm not saying it's not possible, but I think that becomes like a bit of a problem. And the second thing, which I've also seen enterprises and companies struggle, is the quality of data, right? Like you might have data that exists in a certain way, but often the quality of that data is not great, which means then in certain cases it might become like a garbage in, garbage out thing. But I've seen some of these models work very beautifully in some usage-based models, right? Like which are difficult to forecast fairly and like a little challenging. So I've seen some of our customers use these statistical methods to forecast consumption or usage-based sales and revenue numbers. And I think that's where they work great, I guess.
Beautiful. Now that's a super thorough evaluation of these. Obviously, these are not the only four methods to forecast SaaS. These are just a couple of that we've seen in the marketplace, but there's a million more that we could go over today if time permitted. What I'd love to do, though, is keeping these in mind, that there are various methods out there. I'd love to talk a little bit about triangulation. Christian, I know this is something that you've spent a lot of time on and you have pretty strong opinions on. Could you give everybody here an overview of really what this is, and then maybe even some practical examples of how you implemented this in your forecasting methodologies in the past?
Yeah, so triangulation is a way to stress test your forecasts and to improve the accuracy. And the way to do this typically is you use multiple forecasting techniques in parallel. And I strongly recommend that everyone considers this. But it's important which methods you combine. The first recommendation is to try and combine a judgmental method with a statistical method. Why? Well, they have opposite advantages and disadvantages. The judgmental methods have human biases, but they take nuances and intricacies into account. But the statistical methods, they don't have any or almost no human biases, only those related to the input into the model. But they don't take those nuances into account. So when you combine them, you can find a better middle ground. And then the other thing is combine top-down and bottom-up methods. So for those of you who aren't as familiar with the terms, bottom-up means you start from scratch and you layer your opportunities or your projects or your drivers on top of each other, and then you see where you end up. And top-down is more looking at the business holistically, starting at a high level, and then building the forecast that way. And typically what you see, especially for sales forecasting, the bottom-up is created by the business teams, so by marketing, by product, etc. And the top-down is often created by finance. And I've done over 10 budgeting seasons, planning seasons, they never match, right? So the top-down is usually more aggressive. The bottom-up is usually more conservative. There are psychological reasons there. The people who are preparing the bottom-up are the people who need to deliver it, and they want to be able to exceed expectations. So they put a lower number. The leaders, often in finance as well, often a bit farther removed from the business, are a bit more ambitious. But it's not bad that there is a difference. It's actually a good thing because it's a good conversation starter. You can take this, you can meet with your business partner, and you can say, hey, I got your bottom up, I've done my own calculation. Can I walk you through my calculation? And we can talk about where we have different opinions or where maybe I'm underestimating a risk, let's say. And those conversations can teach you a lot about the business, and they often then result in a forecast that's much more accurate than either of the two plans.
That's a super good overview. Thanks so much, Chris. I like what you said there about how judgmental methods and statistical methods, they have opposing advantages and disadvantages. So by using both, you're in more or less terms canceling out the disadvantages of one and the advantages of another to kind of center on an item. My question to you, you actually read my mind on the second piece there, was going to be how realistic is it that the top-down matches the bottom-up? You said they never match, which isn't necessarily a bad thing. Let me ask you this. Is there a threshold or a margin of error between the top-down and bottom-up that you would consider this is reasonable, where I would trust the forecast more or less? Or if it's outside this threshold, we need to review one or the other, or maybe both, to make them a bit more realistic?
So sure, you want to avoid that there is a very big gap, because then you have discussions that are maybe not that useful, right? If there's a big gap. And so actually what companies do, and what I also recommend, is so the bottom up you shouldn't share your top down before the bottom up is done with the people, because then it influences them too much and they may just match the number, and then you magically have no difference, and that's not good. But what you can do is you can share guardrails where you say, okay, we're still working on a top down, but roughly this is how much we're planning to invest in marketing. This is roughly our headcount. This is roughly what we're expecting, what investors are expecting in terms of growth as a range. And that gives people an idea, and then you avoid being very far apart with the two plans.
Phenomenal. No, that's super helpful. Now, I know we only have a couple more minutes left here, but let's just give a quick overview of what we've spoken about so far. First, we identified that your time horizon for your forecast matters. You may forecast a little bit differently if you're looking at just the next quarter, which may be a bit more bottom-up approach, looking at your sales rep, asking them what's in their pipeline, versus if we're a year from now, those pipeline assumptions are going to be much more broad with a little bit more leeway. Then we have to actually select the approach that makes sense to us. We've given a couple here. There are more out there, but there are factors that you should consider when making your forecast. One of those could be the time horizon. One could be your actual approach for making that forecast. Once you calculate that initial forecast, the next piece will be to do a suitable triangulation, right? Don't just do one forecasting method. There are ways where you can build in statistical analyses to help triangulate, whether that's judgment-based or statistically based, to arrive at a more accurate forecast. It may be a bit more work, but you will have a lot more accuracy in your forecast itself. And then finally, you want to compare those triangulation numbers, right? If we are comparing them and we see a vast difference, that's something we may want to consider when we're doing a revised forecast in the future. That top-down management approach versus the bottoms-up, more sales-led version approach, they're good. There has to be some sort of guardrails, like Christian mentioned, built in so that we can arrive at some answer that we more or less agree with and understand. So let's take a look at some of these forecasting methods. I'd love to just get an overview from you, Christian, and then input from you as well, Sar, about each of these as we go through them. So Christian, over to you.
Yeah, so when you have a sales-led enterprise motion, and specifically if you have few opportunities that each have a high annual contract value, then it makes more sense to do an expert-led rep-level forecast. Well, why? Because if you have very big deals, you want to spend more time on each individual deal, and you can do that with that method. You can interview the sales reps. You can understand, okay, what are the probabilities here, and that's doable, and that can give you a lot of good information. The caveat is that you're going to be more accurate for the next quarter. You know, every forecast method becomes less accurate the farther out you look, but specifically this forecast method is really mostly suitable for the immediate outlook, because then sales reps just don't have any information about what's going to happen in 10 months from now.
Beautiful.
And so here, when it comes to mid-market SMBs, so now we're moving down market a bit. Here, often, if they have many opportunities, then this rep expert-led method may not work as well anymore, because it's just the complexity becomes difficult to manage. And there, or if it's mid-market SMB, they may not even have a sales team yet. And there, it makes sense to look at the pipeline and have these top-down probabilities, because then you can make sure that you have a standardized approach and you can learn. You know, you're early stage, you're learning. And this is a good approach to be data-based. And then maybe later on, when the opportunities become bigger, you're moving up market, you can work more closely with the sales reps.
Definitely. I like here especially as well that we've called out that there's a different forecasting methodology, or at least a different way of thinking about it, when we're looking at existing pipeline over there on the right, and then new pipeline underneath it. Existing pipeline, I already know those deals are at least a potential option, right? I know a name of a customer. I can guesstimate a probability of me winning that customer based on the feel of the conversation. But for the new pipeline, I don't even know who those possible customers could be. And that's why, hence, these statistical methods, right, need to come into play. I don't know who you are yet, but I know that someone will show up. Someone will be in my pipeline in the future. Moving on.
And then when you have very reliable data, you're using a CRM to capture those. It does make sense to do a sales quota or a capacity model. That's just a different way, really, of doing a driver-based forecast and bringing in more data into the process.
Perfect. And now, before I jump on to the next one, Sarv, any comments on these so far? I know you've got a bit of experience, especially in that second one that I was talking about, but this third one as well. Any thoughts on this that we haven't already mentioned?
Yeah, I think a lot of wonderful insights, obviously, for Christian. So I think the only thing that I wanted to add here is around the maturity of a business and where maybe methods 2 and 3 might be more relevant, where you've got a business that's more steady state, more stable, and a lot of your drivers, you can be fairly confident that they will work out with a certain accuracy based on certain historical values. I think, yeah, that's the only thing maybe. But
beautiful. Good stuff. Well, let's jump to this next one here. This is the prosumer companies with a PLG motion. So I'll jump to you, Christian, and Sarv. If you have anything to add, please do.
Yeah, so now when you're looking at a prosumer company, you have a very large number of leads coming in because you're targeting, your consumers. And there it makes sense to look at your demand gen funnel. So you look at how many visits do my website get, how many convert to free trials, and how many of those convert to paid subscriptions. However, I would also note here that it's important then to combine that with a different method, because this method is it can be a bit shallow, the demand gen method. So it's important I would recommend the driver-based method, where you look at other drivers that impact your growth, not just your funnel, like your product, for example, the changes you're making there, and bring it together in a triangulation.
Awesome. Sarv, anything else on this one?
I think, yeah, maybe some thoughts on triangulation, right? Like, which is actually maybe a little bit before that is, in certain of these companies, there is a large volume of data because there are a large number of customers that you're typically signing with smaller ticket sizes, a large number of people that flow through the funnel. So a lot of statistical techniques become also very interesting here. And we've seen certain customers use some bit of these statistical techniques to forecast or maybe to triangulate the number that you can get from a top-down demand gen method. Yeah.
Triangulation seems to be the big takeaway theme from today's call, that's for sure. So let's take a look at this last one here. Hybrid/multiple growth engines. What are we talking about here? Is this our triangulation really coming to practicality here, Sarv?
Yeah, so we actually... Go ahead.
Sorry, Christian, please go ahead.
No, I just wanted to briefly say that we basically... When you have a hybrid and multiple growth engine model, that's where you definitely want to combine different forecast techniques. I would actually recommend everyone does this, but if you have a hybrid model, more complexity, you need to iterate, you need to experiment, you need to try different methods.
By hybrid, Christian, are you talking about, there might be a bit of true SaaS in there, number of accounts multiplied by a dollar figure, plus maybe like a usage-based account or a service implementation fee. Is that kind of what you're talking about?
It could be that, or for example, Squarespace sells to consumers, but they also have a business-to-business arm where they have a sales team and they reach out to companies who want to purchase, 100 websites. So they need to look at multiple methods.
Beautiful. Makes perfect sense. All right. So let's talk a little bit about eliminating forecast bias. Christian, this is your area of expertise. You mentioned a couple of things on it today, but anything else that you'd like to call out here?
So what I like to call out here is quickly in terms of sources of bias, there are a few issues that are very common. For example, there could be political pressure, external pressures, It could be a status quo bias, meaning people think what has worked in the past will definitely continue working the same way in the future. Confirmation bias, for example, that's assigning more weight to information that confirms your belief and ignoring other things. And we have narrative fallacy. It's where people want to see a story everywhere, and they see meaning between data points where there really is none. Dunning-Kruger means that someone who is an expert in something often underestimates their ability, whereas someone who is new in a role overestimates their forecast abilities. And ignoring unknown unknowns means that, and that's often an issue, especially in sales, is that there are things that could derail a deal that you just can't foresee. And so you have to put an offer for that. You have to put an adjustment that even though you're very certain some of these opportunities may not convert. And so once you identify these biases, first you need to measure them. Measuring in the sense of calculating your average difference between your actuals and your forecast, and then tracking that over time. And then once you've measured it, it really comes down to collaborating, going out, asking questions to the people who give you their inputs, or asking questions to the data if you're using a statistical method, and trying to go behind, okay, how much rigor did we put into those estimates and what influenced those? So I always like to ask people, okay, can you walk me through step by step how you came up with that estimate? And then you can often uncover that there are biases and gaps in the thinking that you can address.
That's super valuable. So this would all be the first sort of step of eliminating first forecast bias, just knowing that they exist and knowing what you could sort of categorize them as. Is that right?
So actually, this covers the whole process. So you start with recognizing it, then you measure it, and then as a third step, you address it by reaching out to people and trying to understand step by step how did they come up with the numbers. And you can also question the data in a statistical method to see are there any database biases that you may be missing.
Incredible. That's super valuable. And we'll be having some checklist items on everything you're seeing here today as well, in case you want to review the data. So, gentlemen, that was a great discussion. You obviously mentioned a little bit about these steps right here. Let's talk a little bit about this demo that we're going to jump into that Sarv is going to present to us. Sarv, you want to give an overview here quickly, and then we can jump into it, and I can put down my screen and you can share yours.
Absolutely. Thanks a lot, Kirk. So the example that we have for you today, so we'll take an enterprise SaaS company that is looking at forecasting their new bookings for the current quarter. And the methodology that we'll be adopting is the bottom-up rep or manager level forecasting approach. And we will then follow that up by triangulating it with stage-weighted and forecast category-weighted forecasting models. So that's the context. Maybe with that, Kirk, I can share my screen.
Lovely. Very much. All yours.
Yep, 1 second.
Perfect. So we see the ARR forecast category based here.
Yeah, I think, yeah. So before I go into the detailed methodologies of or the approaches of the forecasting models, I basically want to walk very quickly through a very high level overview of the findings from the forecasting process. So what we have here, what we're forecasting for this quarter is close to, let's say, 43.9 million. So this company is forecasting 43.9 million. And this is the number that has been derived at a bottom-up level from the numbers that have been entered by sales reps. There's also a manager forecast which stands at 40.7 million, which is used to triangulate a 43.9 number. And we also have stage-weighted and forecast category weighted numbers, which are in the range of 48 and 42 million. So roughly everything within that similar ballpark of the number that we got from reps. So this is the number that we see here, right? Like, and you can come here and you can filter out any rep here, and that will tell you the forecast for that rep. There are also, you can also start conversations here, right? So for example, you can just say this number looks high. And this is the idea, I think, where Christian was also talking about, which is where you want to ask sales rep certain questions, right? And you can do that on the platform here, and you can start a conversation with the team in product in context of the number that you're seeing here. You can add certain details around the key deals that make up this forecast number, and also the main reps that contribute to this number. So here we have like a rep-wise view of the forecast numbers that have come up from different reps and the numbers that they're forecasting for this quarter. All of this, what you're showing you is just an example. This is entirely customizable, and you can structure the reports and things that you want to see here based on your business. So interestingly, we come to the second part of it, which is the triangulation bit, right? Where broadly the three approaches to triangulation that we were talking about. We have the RVP number, which stands here, and then we've got the stage weighted and the forecast category weighted numbers here, and some more details on the stage weighted and the forecast category weighted numbers here, which is, let's say here, the 48.92 million, right? How much of it is present across the different pipeline stages, or how much of it is present across the different forecast category stages, right? And as you can see, a lot of it here lies in towards the mid funnel. So that's slightly concerning. If I were the VP RevOps of this company, I'd be slightly concerned looking at this number. And then you've got certain key drivers, right? Which is because the triangulation methods use probabilities. So these are the probabilities that we've used in the models, obviously, which I will get into a little while. Yeah, so let's first look at this number, right? Like, where is this 43.9 coming from? And this comes from this view, right? Which is a rep level forecast tracker. And this is the screen that your sales reps will see. And this is the place where they will come to, and they will enter their numbers for the current forecast on a weekly level or on any frequency that you prefer. And what we have here is we've got very sophisticated role-based access control. So every rep will be able to see only the numbers that are relevant to them. They will not be able to see deals or numbers that belong to some other rep. So no need to worry on that side. And as a rep, you can see all of my key details here, right? Like, for example, Eddie here, the forecast call that he's made is of 9.1 million. It shows the total dollar value of the deals that have been closed so far, and also the dollar value of the deals that exist in various stages of the forecast. So fairly confident about the 8 million that he's committed and some pipeline that stays here. And now what Eddie can do is come here and just click on edit values and say, I'm fairly confident about the 8 million here, probably will close to like 1 million from the 5.2 million that I have here based on the deals that I have, which again are present here. So you can come here, just click on edit values and just make this change. Yeah, let's say, yeah. So just make this change and just click on done editing, right? And the numbers will get refreshed automatically. So in this case, we've taken an example where the rep manually enters their number. There could have also been an example where it could have just been a sum of what you have in commit or a percentage of what you will have in base case and pipeline. So this is the forecast call that gets updated. And interestingly, when, let's say, Eddie comes back a little bit later and just wants to re-update the forecast number that he sees here, he'll have a look at all the deals that that are supposed to close in this quarter. We are pulling these deals directly from SFDC or from any other CRM that you have. And what you can do here now is you can start playing around with the deals, right? Like, this is the opportunity that I have, which is right now in pipeline base case. And now we can start forecasting at a deal level to say that, let's say, I want to change this from best case and I want to move it to forecast. And yeah, this is 7 million looks fine. Actually, I'll just forecast a little lesser. So maybe I'll forecast 500K for this and just click on done editing. And again, based on the edits that I've made here, the numbers here will keep updating and he will get a sense of where exactly in the pipeline is his forecast number. And then based on that, like maybe submit another updated call, right? So close to, let's say, 8.5 million. Yeah, maybe I think 9.5 million looks good now. So yeah, just come here again and change this number to 9.5 million and just once submit this.
So Saurabh, as you're making these updates in the report, even though you're in the reporting section and not that modeling section I see on the left, this will flow through the entire model and my forecast gets updated, even though I'm making it in the reporting section. Is that right?
Yeah, absolutely. I think great question, Kirk. I think when we do the forecasting or the triangulation forecast around stages and forecast categories, I'll just show how that happens. But yes, you're exactly right that this will flow through the entire model if this is an input that is being used in the modeling part anywhere else.
Well, it's good to see Halle Berry has some very good forecast numbers. Jennifer Lopez to pick it up a little bit. But
yeah. So, so just like based on like the methodology that I was showing, every rep will enter their number, and the number that we see, which was a 43.9 million number, is an aggregate of the number that has been entered by all of these sales reps. So that's the way of getting input from the reps. And effectively, managers follow like a very similar process where the managers can come in and they'll have a dedicated space for them where they can see, like the reps, they can see all of their relevant details for the current forecast. Again, they will see all the deals that belong to the reps that are under them, can similarly play around or like make changes just the way I did in the previous stream, and accordingly like make a commit for the quarter that they want to for this. So again, bottom up coming from the sales managers, this is the second number, or in a way we are now triangulating the number, because sales reps tend to over forecast a lot of the times because of bias in their deals, and reps tend to be a lot more conservative with respect to managers tend to be a lot more conservative with respect to their numbers. So this is where the like 40.7 million number is coming from. I'll quickly move to the last two, or the models that are powering these two numbers, which is stage weighted forecast and forecast category weighted. So like we've just done very simple models here, and this is the probability based model, right? Where effectively what we've done is we've pulled in all of your pipeline or all of your opportunity data from Salesforce or any other CRM, and we've split that by the various stages that's there. So you can just go to, like, I'll just quickly show how that's done. So this is the opportunity data, which is getting refreshed at whatever frequency, every 6 hours, every 3 hours, or maybe once a day. And then you can apply any sort of filters, and just like very similar to a pivot, any sort of filters can be applied to arrive at the calculation that you want for your pipeline. And so this is the pipeline that I have at this point of time. And then I have the option to add probabilities. The interesting thing that's happening here is we are right now picking up probabilities from sales, from the SFDC data, but as a finance person, right? Like if you feel that this is too high and you want to change these numbers, you can do that in the section here, right? Which is something what Kirk was also mentioning. So let's say 50% for a proposal seems too high. Like I think it's 40%. So you can just come here and edit this number. And the numbers that you see here for the triangulation forecast, that number will change. So this number got updated and it got reduced from the earlier number that was present here. So very, very simple. Once you have probabilities, once you have pipelines, you can multiply the two together and then you get the probability weighted number from the existing pipeline that you're looking at, which we're using for triangulation. Very similar approach we use for forecast category, where we derive the pipeline again from your Salesforce data, add in the probabilities based on the various forecast categories, multiply the two together to forecast ARR from the open pipeline, and then add closed one to it, and voila, we have the bookings forecast number here. So maybe I'll pause here. This was like a very quick demo to show how some of our customers are using this. Maybe with that, I will hand it over to you, Kirk.
Thanks so much, sir. No, that was super valuable. Really appreciate you walking us through that. Let me take the screen back, and then we can actually go through a couple of other things here based off of what you've just showed us. Let me reshare this. We're going to go back to another poll here. So maybe if that one can come up. And then we've actually got a couple of things here that we want to look at. This poll here is just going to ask you if you're interested in a personalized demo of Drivetrain. Maybe you're already a customer and you're just interested in learning a bit more about the tool in our future. Maybe it's not ready for you right now, but if you are interested, a couple of reasons that you may want to do that. We are actually the leader as of G2 today for all FP&A software, a highest rated tool. You see a couple quotes here from our customers. Definitely check us out online. We have very strong customer use cases, a very extensive blog that you should definitely go to check out a variety of other learning-based tools to either forecast, close the books, consolidate, do other forecasting methods that may not be B2B SaaS related, but definitely worth checking out. A couple of other things that we may want to go through today is Q&A. I see a couple questions coming through here. One of them is, this one's for Christian. So be ready for this, Christian. Do you have any tips on how to balance simplicity/scalability and funnel complexity in SaaS forecasting methods? So simplicity and scalability / funnel complexity. What's the best way to balance this?
Yeah, no, that's a great question. So the level of complexity in your model is extremely important to pay attention to. that you shouldn't just focus on the accuracy. Complexity matters. And the reason is, well, if your complexity becomes too high, you can run into error stacking issues. Like I mentioned before, if you have a lot of drivers, a lot of different factors, the margin of error for each of them can add up or even multiply in some cases, depending on how your model is built. And the disadvantage of a high complexity in the model also is that you have less transparency. So if focus accuracy drops all of a sudden, it becomes difficult to figure out why that is because there's so much going on. So the recommendation is to iterate and try to keep the complexity as low as it absolutely needs to be to get the accuracy you're looking for.
Got it. So you would advise teams, FP&A teams in particular, to not go the complex route while hiring more, but rather keep it simple and not as complex as possible. Is that fair to say?
Yeah, I mean, you need to have a certain level of complexity, but the main takeaway here is to iterate, to try different models and see which one works best.
Got it. Good answer. So we have one more here for you, Christian. How do you account for large outlier deals that you know will close a few of each year, but will make or break your forecast dramatically and impact the operational inputs required to obtain your target? So essentially, these large deals that you know will come or maybe will or won't, how do you account for those in your forecast?
Yeah, so that's a good question, a question I often get. So an outlier by definition has a very low probability of occurring. And
Sure.
It's important to keep in mind that we don't have a magic crystal ball where we can predict these unlikely events. So all we can do is we can look at the data we have. For example, you can look at the last 3 to 5 years of data and then see how many of these outliers did you have, and then divide that total amount of outlier sales by the number of years, and then you have something you can include in your forecast. Now, you might say, well, if I divide it by 3 and it will happen, my forecast will be wrong, and if it not happens, my forecast will also be wrong, so isn't it definitely wrong? Yes, but it's important to keep in mind that you'll never have perfect accuracy, and if you use this approach to dealing with outliers, then at least your forecast will be closer to either scenario.
Got it. Brilliant. And then I have one more here before we call it a time for a couple more questions is, which model would you recommend for seasonal peaks? For example, March and July have often been good months for us, whereas September and December have often been a little low. So essentially, we're accounting for seasonality. Is there one method that fits more than others, whether that's statistical, judgment-based?
So actually, you can use any method, and then I would recommend you deal with seasonality in a second step. So first, you calculate, you run your model, choose your forecast technique that fits best, and forecast the next year, let's say, the next 12 months. Then you have a number, let's say 100,000 additional subscription in the next 12 months. And then you apply the seasonality. How do you do that? Well, you can take last year's monthly or even weekly or even daily sales, and then use it as a baseline and allocate your forecasted value to the days, weeks, and months according to the same seasonality of the previous year. That's a common method of dealing with.
And sorry, would you have anything to add to that one? Have you dealt with that?
Yeah, that's an interesting one. So typically, like for some of the customers, I've seen a driver-based model where what they do is they incorporate the seasonality in the drivers that they have picked in the model, right? Maybe with respect to the close rate that will exist at that point of time is higher towards those months, or in terms of the number of logos that they expect their reps to close will be higher towards those months. So the idea is to use historical data, get some sense of seasonality, and then use that seasonality in the form of a driver in your model. So this is one thing that I've seen typically some of our customers use. So yeah.
Beautiful. Now I have a couple more coming in here. It says, can we track week over week forecast movements at a seller level?
Yeah, maybe I'll take that one, Christian. So how the overall process works.
Well, losing you a little bit there, Saurav, on the connection. Christian, are you having the same thing I'm having?
Maybe a week of both. suddenly comes to 500K. So that's possible.
Sorry, I'll be honest. We missed most of that due to internet connection. But maybe if you could type it in the chat as well, we can answer it there. Christian, any answers on you?
So whether you're tracking weekly or monthly really comes down to the volatility in your business. For some businesses, it's absolutely essential to track weekly or even daily. For others, it would be completely overkill. So I want to stay away of giving a one-size-fit-all recommendation, because it really comes down to the volatility in your business.
Fair enough. All right, one more here that we've got. It says, for PLG, how do you think about quantifying product improvements? For example, if we expect a product improvement / new feature to improve conversion rates to paying customers, how do we actually go about figuring out the percentage or dollar impact?
Maybe I'll take this one. Sorry, I hope you can hear me now, Kirk.
Perfectly. You're good.
Yeah, so this is an interesting one again. I think it depends on the maturity of the business that you're forecasting. So in companies that are more stable or larger in size and have gone through a lot of product cycles, some of these percentage improvements are documented when these features are being built out. And that obviously is an assumption that the product team or the business team comes up with. And you use that as the initial number in your forecast. Obviously, as it goes live, then you can kind of gather more data, and then you understand whether those assumptions that you had initially imagined, whether they live up to the numbers. And so this is the way a more established company does it, and we've seen them doing that. In case of companies which are more early in their product journey, right, a lot of this information is not known upfront, which is, I think, where this question also stems from. So in those cases, I think we've seen companies still assume like a ballpark number and then iterate more quickly and get that actual data flowing as soon as possible to kind of start plugging in and verifying those assumptions again and again. So, yeah.
Awesome. Christian, anything you'd add to that?
Just for people to keep in mind that this is tricky, right? This is not easy to forecast the impact of a product change. And so also I would advise people to keep in mind it's an art and a science. Don't overthink it. If it's a small change in the product, I would even just say, okay, we'll assume it gets captured with the other forecast method. And if it's a major change, that's exactly where I agree with Gaurav about how to go about it.
Beautiful. All right, I see a side note question here. This one that I'll take. It says, will this recording be shared? Thank you, Aaron, for the question. Yes, it definitely will be. We have not only the recording, we have a cheat sheet, the masterclass registration links will all be shared. If you haven't already put in your details in one of the polls, or if you wanted a Drivetrain demo, you can 100% reach out to us. That detail will all be listed right here. One more question, though, but before we call this right now. This is an interesting one regarding the cadence with which we have either leadership, sales ops, or sales strategy meetings. Within a quarter, how often would you have those meetings? GTM leadership, sales ops, sales strategy, or anything of the like? And then maybe even in a year, if you'd break it out into a quarterly level.
I can get started. So there, I think it's important to keep in mind that you should have two cadences. You should have one that is independent of where you are in the fiscal year or in the quarter, because you should have a close relationship with your go-to-market team as a finance leader. You should have weekly, monthly, better weekly touch points, even if you're just joining one of their operational meetings that they're already doing, because that's how you can make sure that you're close to the business. You can spot changing trends earlier and you stay on top of things. And in addition to that, you have a separate meeting cadence that's related to your quarter-end close, your year-end close. And they often are driven by board meetings, for example, that happen at the beginning of a new quarter. And there, of course, as you get closer to the board meeting, it's more important that all the leaders are aligned. And then you'll have more meetings towards the end of the quarter.
Makes total sense. Sorry, would you say that's more or less true in your experience as well?
Yeah, I think Christian captured it really well. But there are some nuances around this sales of the DevOps team meeting a lot more towards the close of a quarter or maybe the close of a year. But I think otherwise Christian captured it beautifully. Yeah.
Beautiful. Well, guys, we've timed it absolutely perfectly. We have 1 minute remaining. Again, everybody, thank you so much for joining. Christian, thank you. Saurav, thank you. any last words on this topic before we call it a day? Looks like we're good. Well, guys, thanks for joining this webinar for today. Christian, again, thank you very much. Keep up to date with us by going to our website. You can sign up for any of our blogs or emails there, and we'll continuously send those out. You'll have access to all of our resources. And look out for our masterclasses that we have in the coming months. We're really looking forward to connecting with you guys. Thank you so much to everyone who joined. Have an absolutely awesome day.